I have Oscarrson, Sarah Smith, and Eli Yim of our offices strewn about various places. And so what we'll be doing is kind of going through kind of a discussion and a few questions as we work through. I've got a PowerPoint that with any luck, I will be able to share my screen so that we can work through that. And Eli, give me a thumbs up. Sarah, if you can see my screen here. We're good. All right. Look at that. That's amazing. So the tax issues are really challenging and often get overlooked because particularly in a partnership setting, and I use that word partnership intentionally, and even though the title of our presentation has to do with tax issues and LLCs, because LLCs can be taxed in a number of different ways. And this is something that often gets lost on members of an LLC is they can choose to be taxed as a corporation, whether a C Corp or an S Corp. They can elect to be taxed as a partnership. They might even be what's called a disregarded entity. And Sarah Smith will share a little bit about what in the world a disregarded entity is, or I like to call it a tax nothing. And so what in the world is that? Why would we do such a thing? And then of course we say tax issues as if that narrows it down, because there can be income tax consequences, there can be capital gain tax consequences, there can be real estate excise tax consequences. So there's sort of to say, oh, there are no tax consequences. Boy, you got to be really careful with that, because there's all kinds of different tax possibilities. So we're going to try to keep this simple. We're going to try to keep it focused on a real estate context with LLCs taxed as partnerships. And one of the things that I'm going to tell you, just in terms of a takeaway from this webinar, write this down and sleep on it, never let it leave your side, is if you own real estate and you want to own that real estate in an entity, don't own it in a corporation. Don't own that in an LLC taxed as a corporation. And we'll talk a little bit about that. That is as close to a hard and fast rule as we get. And so what like to do is I'd like to start by getting into these issues. Eli, what I'd love to do, if I can, look at that, I can change the page. Love to throw this over to you to talk a little bit about taking the real estate and putting it into the LLC and taking it out, and what some of those consequences might be from a tax standpoint. So I'll throw it to you. It's all yours.
Okay. Well, I feel like I need to take a little bit of a step back and continue with the theme that I think David has set up here, which is, we are talking at a super high level and trying to keep it as simple as possible. But, when we think about taxation, we particularly when it comes to income, we think about realization events and what results in income that is subject to taxation. What is the triggering event? The example you might see in your own finances is, you purchase a stock, you establish the tax basis, you sell it later for some certain amount, and you pay tax on that gain. And the same thing would be true with real property, right? You have a tax basis established, you sell it, that gain is then taxable upon sale, which is the triggering event. And so the question that I think we're talking about here today then is, what about the transfer of real property into an LLC that is set up to be taxed as a partnership? Is that a realization event or a triggering event? And if we look at the IRS code, section 721A, right, it tells you, no, it is not. There's no gain or loss recognized to a partnership or its partners where the contribution of property is made in exchange for interest or in the partnership. And so there is that is not a taxable event or realization event when you transfer property into an LLC. It is tax-free both to the contributor and to the LLC. So
so Eli, if I could rudely interrupt,
Yeah.
you use that word contributor, and so from a in an LLC standpoint, we have typically members, which are similar to partners. Why do you? I was going to ask you a why question, which probably isn't a fair thing to do, but I think it's important that everybody understand that when we're talking about LLCs that are taxed as partnerships, while you may be a member, the tax code says you are a partner. And so a lot of times when we talk to accountants, we find that we end up talking past one another because lawyers use the term members, which is a state law term for that gives some description of what an owner has. And I just hate that word owner when we're talking about LLCs, because you can as a member, you have certain rights, but you could also be what we call an economic interest owner or a transferee or an assignee. And all of those from a tax perspective are going to be treated as a partner. And so Eli correctly uses the term partner here because we're talking about tax consequences here. And yet, if you look at our LLC Act, the word partner isn't even there. And so Eli, I've rudely interrupted enough. I'll throw it back to you to keep talking about 721 and 731.
No, that is a great point, though, because exactly, we think as far as members and membership interests, we don't talk about ownership, right? And certainly when we look at the tax code, it is in reference to partners. And so making that connection is very important. So yes, so 721 governs real property that is transferred into the LLC, and section 731, sorry, that was 721. 731 governs property that is transferred out. And again, with 731, a lot like 721, no gain or loss is recognized to a partnership on a distribution to the partner of the property. So going in, not a taxable event. And again, we're speaking high level, and coming out, again, not taxable as an event. So those two sections of code are what you would need to know about if we were talking about transferring real property in and out of an LLC. We also should think about, and if you've ever sold property in Washington State, you're familiar with the real estate excise tax. Under the Washington Administrative Code, a transfer of property here that does not involve the realization or recognition of gain or loss, and this is important, under section 721 or 731 of the tax code, is not subject to the real estate excise tax. So again, consistent with the federal tax code, under the Washington Administrative Code, you should not see a real estate excise tax.
So what Eli has just said there is really important, and it highlights this what I call the for what purpose doctrine. There's no tax for what purpose. So we're talking about not an income taxable, a realization event, I should say, under the Internal Revenue Code, but yet there's this. That's at the federal level, but there's a whole nother state law regime we have to worry about. And the slide makes reference to excise tax consequence, and we cite the administrative code Eli has right there for us, which is a specific exemption that says, if you have a transaction that looks like this, we're not going to hit you with excise tax. And this is really important from a practical perspective, because what this in effect allows us to do with LLCs, tax as partnerships, is to have an enormous amount of flexibility associated with a given piece of real estate. Because one of the things we know is that there is enormous change that happens. And if you are taxed all the time when title changes, even though there hasn't been any money that's changed hands, because you'll notice Eli never once said that you sold the property. You may have transferred it into an LLC. Well, you didn't make any money when you did that. And when you transfer the property out of the LLC again to one of the members, again, Eli, nobody got any money, right? No money changed hands.
Correct.
And yet, if you're in a corporate setting, then that would be a realization event. And so the slide here that Eli have, LLCs taxed as partnerships are not corporations. Really important that we understand that from a real estate context, because completely different tax consequences, right, Eli, if we're talking about corporations, right?
Yeah, far more complex.
Far more complex.
Yeah.
And so and that's saying something, because the regulations for subchapter K and dealing with contributions to partnerships and allocations go on for hundreds of pages. Just yesterday, I put a blog post up a little bit about that. So it is mind-numbingly complicated, and yet corporate stuff is makes it even worse than that. Eli, what did I miss? Anything more you wanted to say about that slide?
No, I think the takeaway is just the LLC, kind of what you said at the top of the presentation, the webinar, which is, a lot of the reason why we love our LLCs for our clients is the flexibility that it affords them. And this is just another proof point for that we can share with our clients.
Another reason to love LLCs.
Yeah.
Well done, Eli. Love it. So, Per, like to throw the mic over to you. Now there's something that may be completely foreign to us, things like capital accounts. Enlighten us on what in the world that's all about and why it matters.
Okay. Well, capital accounts are there to kind of keep track of the contributions that Eli talked about. If it's a contribution of cash or property, whether it's real estate, maybe equipment, something like that, that's the first thing that goes in when you make that contribution to the LLC in exchange for a membership interest. You have contributed capital. Well, you're going to get credit for that, but you're going to get credit for other things too. For example, the income for the LLC gets allocated among the members and it adds to your capital account. But other things may decrease your capital account. One would be where the LLC distributes property, reduces your capital account. The unfortunate circumstance.
So Per, again, occupational hazard, rude. I was rude to Eli. I guess I'll be rude to you as well. You use some magic words there. You use words allocation and distribution. Those sort of sound like the same thing. Are they the same thing?
No. Allocation just says based on your interest in the LLC, this is how much of income, for example, of the LLC will be allocated to you. But the allocation does not actually involve a transfer of any of that. It just says this is what you are entitled to. The distribution, on the other hand, is the actual transfer of income. So if your capital account, for example, says $100,000, just to pick a number, and there's a distribution of $50,000 out of the income, well, that will reduce your capital account by $50,000 because it's actually been a distribution. You've actually seen something come to you, as opposed to an allocation where it's just telling you this is how much either the gain, great, that I'm going to be entitled to, or maybe a loss that I have to bear my proportionate burden of.
All right, I'm done being rude.
So there are a number of things there, that, like I said, the income and loss. If there are some capital gain distributions that may somehow come into the LLC, those would all affect the capital accounts. And they're very important because you do need to know what is your financial stake in the LLC. And it's not just members who get a capital account. There's a status known as an economic interest holder. There are other terms that are kind of synonymous with that, where the person may have a financial interest, but they're not a member. The difference being that financial interest alone does not give you the right to participate in management, whereas the status as a member would. But if you're an economic interest holder, and let's say the LLC is going to make distributions, they make distributions to the economic interest holders as well as the members. So it will be important that the capital accounts for the economic interest holders who are not members are maintained just as they would be for capital accounts that are held by members. It can get kind of complicated. You see on the slide there, built-in gain issues. That one is a really complicated issue, can be a really complicated issue. And it deals with, for example, one of the people who wants to become a member of the company, the LLC, bought a piece of property for $50,000 and has held it for years. Now they're going to contribute it to the LLC, but it's now worth $100,000. If instead of contributing it, that property had been sold, they would have had $50,000 of gain. So there are a number of IRS rules dealing with built-in gain so that that gain can't be kind of sent off, if you will, to other economic interest holders who may not have to pay as much tax when that gain is realized. So there are, like I say, a number of rules, and I think the Internal Revenue regulations on it come to several hundred pages that deal with how do you account among the members and the economic interest holders for built-in gains, because at some point it will become important.
Absolutely. And typically that at some point is perhaps when the property is sold or when the partnership is liquidated. And one of the things that we all hate is surprises. And a lot of surprises can come at that point in time because of, Per, as you say, those built-in gain issues or the allocations that maybe weren't done properly over time, or maybe they weren't even thought about at all. And so to avoid surprises and having a bunch of income that maybe you didn't think you were going to have, it's really important that that partners understand all of that stuff. So Per, I think that's really well said. Anything else you want to add on this slide, Per?
Well, just kind of to take it a little bit further, if you've got a single member LLC where you think, well, gee, I don't need to keep track because I don't have to allocate it among different members. You figure, hey, I just won't worry about capital accounts. Well, that could be quite a problem too, because you may not be thinking about it now, but maybe 5 years down the road, you bring in a new member. Now, if you don't have the capital account established and adjusted as time goes by, now you're gonna have to recreate the wheel for some period of time. And that could be a real significant problem.
Absolutely. No, I think that's a great point. So with that, suffice it to say that we could go for days just on this slide, but to make sure that everyone stays awake, that we'll go on to the next one. And Sarah, I'd love to flip this with you because Per actually gave us a nice little segue. He used some magic words there. Single member LLCs. What in the world is that? And maybe talk a little bit about. I said before, you can be taxed as a partnership, taxed as a corporation, and lead us down this road and how that applies with LLCs and their tax issues.
So as we sort of touched on very, very lightly, how an entity is organized and how an entity is taxed can be an incredibly complex issue, and you would really don't want to leave that up to guesswork. And in the spirit of that, back in '96, the IRS proposed and later finalized regulations which allow a business to elect how it wants to be taxed under the aptly named check the box form, Form 8832, which is the entity classification election form. So when you hear people talking about check the box and check the box elections, that's what they're referring to. And basically what this does is it breaks it down into 3 classifications. Entities which are taxed as corporations, entities which are taxed as partnerships, and entities which are disregarded. You don't need to elect if you're going to go with the defaults, which are as follows. Business entities who are classified as corporations are taxed as corporations. Gotta love the logic in that. You can elect to be taxed as an S Corp versus a C Corp. Otherwise, if you are not a corporation, businesses are essentially broken down into two categories, which are entities with multiple owners or entities with one. Those who have multiple owners are automatically taxed as partnerships unless they elect otherwise. And those who are single owners are automatically treated as a disregarded entity. It's worth noting that in Washington, if you are a married couple, despite being literally two people, you can still elect to be a single member disregarded entity. What does that mean, though, a disregarded entity? It means that, in effect, you can elect to be a single member LLC and still get all of those wonderful benefits that come from being an LLC, liability protection and the like, but you don't have to deal with quite the same headache that we've touched on when it comes to taxation and keeping track of those sorts of requirements, because the IRS is going to look through and say, well, we're just going to treat you like a sole proprietor. We're going to treat you like an individual. You aren't going to have to deal with the extra layers that come from being taxed, say, as a corporation, for example.
And I was rude, Sarah, to everyone else. I guess I'll do that to you as well, because I really want to highlight what you just said there and how important that is. So, for example, if someone owns a rental house, single family residence, as a husband and wife, they can transfer that rental house into a limited liability company and get the asset protection, that shield that an LLC gives, protects the owners from personal liability. And yet the IRS looks at that as if it doesn't exist. So be really, you have to be really careful as we talk about this, because even though the IRS says your entity doesn't exist, which means, by the way, you don't have to file a separate tax return for that entity, which is nice. But also, now you get all of the other benefits, and Sarah's touched on those. So it's a really, really nice tool for investors to be able to take one property and put it into an LLC that they control completely, and not have a bunch of additional administrative burden. And so that's a very, very common and useful tool. And so I did not mean to steal any of your thunder there, but I just wanted to highlight that, because even though your entity is disregarded for tax purposes, it still exists for liability protection. Sorry about that.
No, you hit the nail on the head. And it's also worth being specific. It's disregarded for income tax, not necessarily gift and estate taxation. And that's a whole other lecture, but worth bearing in mind if you're thinking about estate planning and gifting. But as far as the IRS is concerned, if you want to put a rental home into a single member LLC, or if you need to fund a new single member LLC, as businesses do need, the IRS sees it as no more as taking from one hand and then putting it in the other. There's nothing to tax because you've gone from being the owner to being the owner. And what's wonderful is that's actually reflected in Washington as well. Washington Administrative Code 458, 61A to 11 says a transfer of real property is exempt from the real estate tax if it consists of a mere change in identity or form of ownership of an entity. So using your example again, one hand to the other. This can also be useful if you're retitling property into a revocable living trust, or if you have a name change and need to retitle a property. There are multiple purposes. But the idea being, again, you don't need to pay that level, just pay another level of taxation just to retitle something from your ownership to your ownership. And it's quite convenient for simplicity. That said, as always, remember when you're dealing with LLCs and these types of businesses, we're really talking about being disregarded for income tax. So make sure you're keeping separate bank accounts, make sure you're keeping good records, treat your business with the respect that you wish it to be treated with.
That's Sarah. That's a great point, because just because we want the IRS to disregard it, we don't want anybody else to disregard it. So that financial separation that you mentioned, absolutely critical. And Sarah does a ton of estate planning for us, and so you can see there's a great deal of involvement that these entities will have from a planning perspective, and it's why there's such a need to have a great deal of flexibility with your LLC being taxed as a partnership. And so our allotted time has passed, but I want to thank Sarah and Per and Eli, and our business and real estate group is just up to our eyeballs in these issues all the time. We love the opportunity to work with you and plan so that we can avoid surprises, structure things in a way that reduces tax to the extent possible, provides you with that asset protection that is going to be really helpful, because owning real estate is a risky endeavor. Then there are a whole host of estate tax issues as well that we haven't touched on yet. But every week, Beresford Booth puts on a webinar 12:15 every Thursday, and so our estate planning group, we just alternate through. Next week, Bill Kessler will be presenting on litigation. And I want to highlight this because in 4 weeks, the business and real estate group will be back again. But in our next webinar, we're going to be talking about transition issues with businesses and going from one generation to the next. And it's a hugely interesting and timely issue that I will be talking with Stacy Grund, a client of mine who his family has done it for 5 generations. And so they are steeped in succession planning, and Tatley Grund and Grund Painting been around for over 100 years. They know how to do it. So Stacy and I will be having an interesting conversation about that. In the meantime, just know that the Business and Real Estate Group, at least once a week on Wednesdays at noon, blog goes up about issues. The last several of them have been on tax issues. So every Wednesday they're there. You can enjoy them at lunch, and we frequently post more regularly than that. So certainly encourage you to regularly check on our website to see what's there. We have an email blast that goes out every week. If you'd like to be on our mailing list, we'll get those to you, and fill your inbox with some useful and timely information. And just want to leave this with you as our contact information. And again, just to remind you, LLCs are not corporations. And it's kind of interesting if you read some even opinions from our courts. They talk about limited liability corporations, and they talk about shareholders in an LLC. That is not an accurate way to think about these things, and these tax issues that we've touched on today. We've just touched the tip of the iceberg here, and certainly be delighted to help you get better acquainted with these issues, because they are significant. So again, weekly blog post every Wednesday at noon, webinar every Thursday at 12:15. And thanks everyone. Appreciate you hopping on.